Hello and welcome to GB News Originals. I'm Adam Cherry and today we're bringing you the latest on the UK's economic landscape. Okay, here we go. So the recent inflation figures have just been released by the Office for National Statistics. These numbers are crucial because they provide insight into the cost of living and the overall health of our economy, the money in your pocket. Now, in a surprising turn of events, the UK's inflation rate has actually fallen to 2.5% for the 12 months to December 2024. That's a slight decrease from the previous month's figure of 2.6%. It's slightly better than economists were predicting, so it marks a positive shift on the economic indicators, slightly. It's obviously good news for consumers across the country, or at least it seems to be, because for months Brits have been grappling with rising prices amidst that ongoing cost of living crisis that we've been dealing with for several years now, really since COVID. And the latest figure suggests that the financial pressures on households might be easing a little bit. We'll talk a little bit more about that later, but for now, the timing of the inflation drop obviously couldn't be better for Chancellor Rachel Reeves. She's been under a lot of scrutiny lately over the last few weeks. When has she not been? Especially after her recent China visit. Now, critics have pointed fingers at the Chancellor for running away during all this turmoil. Obviously, we had borrowing going up, we had the pound slumping, and it looked like we had inflation remaining sticky, so therefore your mortgage stays high. But the recent drop in inflation to 2.5% brings some relief to mortgage holders and, of course, to the Chancellor, but many remain concerned about those mortgage payments in the current economic climate. Here is why people should still be worried and still keep an eye on their finances, because despite that inflation decrease, mortgage rates remain and will remain significantly higher than in recent years. In fact, the average 2-year fixed rate mortgage is still around 5.48%, while the average 5-year fixed rate is about 5.25%. And these rates are still causing financial strain for many homeowners. They're much higher than they used to be. In fact, I actually fixed it around 2.5% a couple of years ago, not to make this all about me, but certainly I'm looking at these figures thinking, blimey, when this comes up for time to remortgage, my pay packet is going to take a significant hit. And I know I'm not the only one who thinks that. The high interest rates have made mortgages less affordable for many, particularly first-time buyers. So households are facing monthly payment increases of more than £500, which is obviously a significant burden on their finances. And it's particularly challenging, as I said, for those coming off low fixed-term rates and transitioning onto those much higher rates. There is some hope that interest rates may come down. The Bank of England is now perhaps in a slightly better position in February to make a cut. But long term, we can still expect interest rates to remain above 4% for a while. The Bank of England's decisions on the base rate will obviously depend on various economic factors, not least these inflation trends. But the uncertainty, of course, makes it difficult for homeowners to plan their finances confidently. That's the whole point of this government, was to provide stability. So this indicator is good, but it's not the full picture. Now, the current economic situation is, as I said, very difficult for first-time buyers because they need to save up, not just for a deposit, but even if they get that deposit, they're facing higher mortgage rates and potential changes to stamp duty relief. That's crucial because it makes it more difficult to enter the housing market in the first place. You also need to build more houses. That would certainly help. Some homeowners are going to need to seek forbearance from their lenders if they struggle with higher payments. And while this can provide some short-term relief, it might lead to longer-term financial implications that will worry them. Even though inflation can reduce the real value of mortgage debt over time, the immediate impact of higher mortgage payments is, of course, huge. I can't stress this enough. This is why this is so important to homeowners. They're worried about how these increased costs will affect their long-term planning. That's the fundamental reason we're here talking about this. The property market's response to these changes adds another layer of concern here because fluctuations in house prices can affect homeowners' equity and their ability to remortgage or move in the future. So there is some hope, but many still remain really anxious about this, about their mortgage rates and about what will happen when they come off those, the sugar rush, if you like, of those short term, or rather of those fixed rate 5-year mortgages, which were fixed when the economy, when inflation at least, was much lower. So what has the Chancellor said? Well, Rachel Reeves has obviously welcomed the news. Of course she has, but she did remain cautious in her response. She said there is still work to be done to help families across the country with the cost of living. Yes. And by the way, the 2.5% is, better than 2.6, of course, but it's still above the 2% target of the Bank of England. And the last time we had that was, I think, under Rishi Sunak, although we'll double check that. But that's why, go back to what Rachel Reeves said, quote, that's why the government has taken action to protect working people's pay slips from higher taxes. Okay, unless you count rising national insurance on employers, but we'll come to that later. Frozen fuel duty and boosting the national minimum wage, which is also inflationary, but never mind. Reeves emphasised her commitment to fighting every day to deliver that growth and improve living standards in every part of the UK. Now, as I said, the inflation rate is still above the 2% target, and that persistent above target inflation suggests that the Bank of England, the central bank, may be less likely to rapidly bring down interest rates in the short term. So borrowing costs will remain higher, but potentially better rates will be provided for savers. So these inflation figures come at a crucial time for Rachel Reeves and the Labour government. When asked in Parliament about the possibility of tax rises and spending cuts in an emergency budget, now listen to this bit because this is the crucial part, Reeves recommitted to the borrowing rules she announced in October in her budget, that famous budget where she stated, we have committed to have just one budget per year to provide businesses with the certainty they need to invest. So we will have an update from the Office of Budget Responsibility, the OBR, in March. Now, Reeves there reiterating the government's fiscal rules, saying we have set out the fiscal rules that will balance day-to-day spending with tax receipts, and we will have debt down as a share of GDP within the forecast period, and we will continue at all times to meet those fiscal rules. This commitment comes amidst concerns about rising government borrowing costs and, of course, the potential for a debt spiral. So all eyes will be on Reeves and her economic team. It certainly didn't help that she wasn't here for the last week. The upcoming update from the Office for Budget Responsibility will be absolutely crucial here. So we need to pay attention to that because this determines the government's fiscal strategy. Should also say that they are only committing to one major fiscal event of the year, but that doesn't mean they can't introduce tax rises or spending cuts outside of those. Really, it's just a branding thing. We used to have a budget in March and then an autumn statement in the autumn. So nothing has really changed other than semantics, but never mind, because with persistent inflationary pressures and these economic uncertainties, really you need to pay attention to what Reeves does, because her ability to navigate these challenges whilst maintaining the government's fiscal rules is going to be really tricky. If she cuts spending, all her backbenchers and her cabinet will kick off and say, we can't support this. We need more money. We need more investment. And if she cuts taxes, or wouldn't that be nice? If she raises taxes, then all the people who voted for her, a significant portion of them, will almost certainly say, this didn't appear in the manifesto. This also wasn't something you promised in that October statement, in that important budget that you made just a few months ago. So whichever way she looks, she's in a lot of trouble. And it all comes down to the fact that she has no fiscal headroom. That's why she's having to make those choices. Again, that's because of the rising cost of borrowing, which is at a 27-year high. So, sorry to rain on the parade a little bit here, but as always, GB News will continue to bring the latest updates on this developing story. And trust me, we ain't seen nothing yet. We're going to be analysing the government's response. We're going to be tracking the market reaction, and we'll keep you informed on how these economic shifts might affect your daily life. This has been Adam Cherry for GB News. Of course, stay tuned for more updates, and remember to subscribe to our YouTube channel for the latest news and analysis. Thanks for watching. Goodbye for now.